Picture this. You're at a family gathering, maybe Thanksgiving, maybe some random cousin's birthday dinner, and someone finds out you're renting. And the look on their face. You know that look. It's pity. Genuine, unfiltered pity. Like you just told them you've been sleeping on a park bench. And then comes the speech. You know renting is just throwing money away, right? And everyone at the table nods. And maybe part of you starts to believe it because everyone says it. Your parents say it, your coworker says it, the bank says it, every financial pundit on TV has been saying it for 30 years. But here's the thing. What if they're all wrong? What if the advice your parents gave you, the advice their parents gave them, is actually outdated? Built for a different economy, a different housing market, and a completely different financial landscape than the one we're living in right now in 2026. Today, we are going to run the actual math, not the cheerful, oversimplified version the mortgage industry wants you to see. The real numbers. And I promise you, by the end of this video, you will never look at the renting versus buying debate the same way again. Let's start with the myth itself. Renting is throwing money away. This is probably the single most repeated piece of financial advice in America. And on the surface, it sounds logical. When you rent, you pay money every month and you own nothing at the end. When you buy, you pay money every month and slowly, you build equity. So, renting bad, buying good, right? Not so fast. Here's what that argument conveniently leaves out. When you rent, yes, your rent goes to a landlord, but when you buy, a massive chunk of your mortgage payment also goes to someone who is not you. For the first several years of a 30-year mortgage, the majority of your monthly payment is going straight to the bank as interest. You're not building equity, you're barely building equity. You're mostly just paying interest. According to data from the Consumer Financial Protection Bureau, in the first year of a typical 30-year fixed-rate mortgage, roughly 80 to 85 cents of every dollar you pay goes to interest. That's not building wealth. That's renting money from a bank. But we're getting ahead of ourselves. Let's put some real numbers on the board. Here's where it gets interesting. And by interesting, I mean a little uncomfortable. Let's say you're looking at buying a $400,000 home in 2026. Pretty average home price in many mid-tier cities right now, not even a coastal market. You put 20% down, which means you need $80,000 in cash up front. Then you take out a $320,000 mortgage at today's interest rates, which have been sitting around 6.5 to 7%. Let's call it 6.7% to be fair. Your monthly mortgage payment? About $2,070, just for principal and interest. But wait, we're not done. Property taxes on a $400,000 home, and this varies by state, but the national average is around 1.1% of home value per year. That's another $367 per month. Homeowners insurance? Add another $150 a month, minimum. HOA fees, if your neighborhood has them, could be anywhere from $100 to $600 a month. Let's say a modest $200. We haven't even talked about maintenance yet, and this is where homeownership cheerleaders go very quiet. The standard rule of thumb, backed up by data from the Harvard Joint Center for Housing Studies, is that homeowners should budget 1 to 2% of their home's value every year for maintenance and repairs. On a $400,000 home, that's $4,000 to $8,000 per year, which is $333 to $667 per month. Let's be conservative and call it $400 a month. So what's the real total cost of owning this $400,000 home every month? Mortgage, $2,070, property tax, $367, insurance, $150, HOA, $200, maintenance reserve, $400. That's $3,187 per month, every month. And that's before you pay a single dollar toward actually living in the house. Utilities, furnishings, all of it. Now, the median rent for a comparable home or apartment in the same area, according to Zillow's 2025 housing data, the median rent for a 3-bedroom home in most mid-size American cities sits between $1,800 and $2,200. Let's say $2,000. That's a monthly gap of over $1,100 every single month. Over a year, that's $13,200 in extra costs from owning versus renting. Over 5 years, that's $66,000. But wait, I can already hear you saying, what about equity? What about appreciation? And yes, we're going to talk about that, but I need you to sit with that number for a second before we do, because $66,000 over 5 years is not nothing. That is money that a home buyer is paying that a renter is not, and what a smart renter does with that difference is the whole ballgame. This is the part of the conversation that almost never gets mentioned, and it is, frankly, the most important part. It's called opportunity cost, and it's the concept that money you've committed to one place is money you can't put to work somewhere else. Remember that $80,000 down payment? That money is now locked inside your house. It's not earning returns in the stock market. It's not sitting in a high-yield savings account. It's just in your walls. Here's what that $80,000 would do if you invested it instead. The S&P 500 has returned an average of about 10% annually over the long run. And even if we're conservative and use 7% to account for inflation, $80,000 invested at 7% annually becomes $112,000 in 5 years. It becomes $157,000 in 10 years. It becomes $315,000 in 20 years. That's not a small number. That's a retirement difference maker. And it's just sitting in your front door as a down payment. And then there's that $1,100 monthly gap we talked about. What if a renter took that $1,100 every month and invested it? At the same 7% annual return, after 10 years, that's an additional $190,000 in invested wealth. So after 10 years, a disciplined renter who invests the difference has potentially built $300,000 or more in liquid, accessible wealth. Not home equity that's locked behind closing costs, realtor fees, and a 60-day sale process. Actual money. Money you can access on a Tuesday if you need it. Now look, I'm not saying homeownership can't build wealth. It absolutely can. But the argument that renting is automatically throwing money away, while buying is automatically building wealth, that argument falls apart the second you do the actual math. Let me show you something they don't put in the mortgage brochure. When you eventually sell your home, which most Americans do, by the way, the average homeowner stays in a home for about 13 years, according to the National Association of Realtors. When you sell, you don't just walk away with your equity. You pay to leave. Real estate agent commissions typically run 5 to 6% of the sale price. On a $500,000 home, because let's assume yours appreciated over 13 years, that's $25,000 to $30,000 walking out the door on closing day. You don't get to skip that. It comes right off the top. Then there are closing costs on the buy side when you move somewhere new, typically 2 to 5% of the purchase price, and moving costs, and inspection fees, and all the upgrades you made to the old house that buyers expected but didn't add to the sale price because the market had moved on. A study from the National Bureau of Economic Research found that the average homeowner, after accounting for all transaction costs, maintenance, taxes, and insurance, earns a real annual return on their home of somewhere between 0.5% and 1.5% per year, not the 5% or 8% that people brag about at dinner parties. 0.5% to 1.5%. Compare that to the stock market's historical 7% real return, and you start to understand why the math doesn't always work out the way we were told. Okay, I want to stop here for a second and be fair, because I'm not here to tell you never to buy a home. I'm here to tell you the full story so you can actually make the right decision for your situation. There are absolutely scenarios where buying makes a ton of sense. If you are planning to stay in the same place for 10 years or longer, the math starts to shift in your favor. Transaction costs get amortized over more years. You're further into the mortgage where more payment is going to principal. And if you're in a market where rents are rising faster than your fixed mortgage payment, that locked-in payment becomes a serious financial advantage over time. If you have strong income stability, a healthy emergency fund, and that down payment is not your entire savings, meaning buying doesn't leave you financially naked, then home ownership can be a smart move. And there's a psychological and lifestyle element to this that the pure math can't fully capture. The ability to paint your walls whatever color you want, to have a dog without asking permission, to feel rooted in a community. These things have real value. I'm not dismissing them. But here's the key distinction I want you to walk away with. Buying a home can be a good financial decision. Buying a home is not automatically a good financial decision just because everyone says it is. And renting is not automatically a bad financial decision just because it doesn't come with a deed. So if renting can actually be the smarter financial move, why does everyone think otherwise? Because the financial services industry, the real estate industry, and frankly, a lot of well-meaning cultural programming have spent decades telling us that home ownership equals success. And there's money in that narrative. Massive amounts of money. Banks make money on mortgages. Real estate agents make money on transactions, title companies, inspectors, appraisers. There is an enormous industry that profits every single time someone buys a house, and not one of those people makes a dollar when you renew your lease. I'm not saying it's a conspiracy. I'm saying when every financial incentive in the room points toward one conclusion, that conclusion tends to get repeated a lot, and somewhere along the way it stops being advice and starts being gospel. The research, though, tells a more nuanced story. A 2021 paper published in the Journal of Urban Economics found that in many U.S. metro areas, renting and investing the difference actually outperformed home ownership in terms of total wealth accumulation over 30 years. Not in every city, not in every market condition, but in a surprising number of them. The enemy here isn't home ownership. The enemy is unexamined assumptions. The enemy is taking advice designed for a 1985 housing market and applying it without question in 2026, when home prices relative to incomes are at near record highs, when interest rates have doubled from their pandemic lows, and when the stock market is more accessible to ordinary people than it has ever been in history. So let's talk about what winning actually looks like as a renter in 2026. Step 1. Calculate your actual cost gap. Take what your equivalent home would cost you monthly, all in, using the formula we walked through, and subtract your actual rent. That difference is your potential investing fuel. If you're paying $2,000 in rent and your mortgage equivalent would cost $3,200, you have $1,200 per month to work with. That is not nothing. That is wealth-building ammunition. Step 2. Actually invest the difference. This is the step where most renters fail. They're not renting strategically, they're just renting. And the money that could have gone into the market goes to a slightly nicer car or an extra streaming subscription. You have to be intentional. Open a brokerage account, set up automatic monthly contributions. Index funds are fine, low cost, diversified, boring. The math works whether or not it's exciting. Step 3. Build your down payment on your terms. Here's something that doesn't get said enough. Renting buys you time. Time to save a larger down payment. Time to let your income grow. Time to figure out where you actually want to live for the next decade. There is no law that says you have to buy by 30 or 35 or ever. What matters is that when you do buy, if you buy, you do it because the numbers work for you, not because the cultural calendar says it's time. Step 4. Stop treating your home as your primary investment vehicle. Even if you do buy eventually, the smartest homeowners understand that their home is where they live, not where they park their entire net worth. They max out their 401k, they have taxable investment accounts, they don't let all of their financial eggs sit in 4 walls and a roof. Look, I know this feels like going against the grain, and it is. It is deeply uncomfortable to question something that has been treated as settled wisdom for your entire life. To sit at that dinner table and not take the bait. To say, Actually, I've run the numbers, and renting makes sense for me right now, and have people look at you like you've lost your mind. But here's what I know. The people who build real, lasting wealth are not the ones who follow the crowd. They're the ones who take the time to understand what the numbers actually say, and then act on that understanding, even when it's unpopular. The data is clear. Renting is not failing. Renting, done strategically, is one of the most powerful financial moves available to someone in 2026. It keeps you liquid, it keeps you flexible, and it keeps your options open while you let your investments compound in the background. Home ownership might be in your future, it might be in your near future, but the decision to buy should come from your spreadsheet, not from your aunt's opinion at Thanksgiving. Run your numbers, know your costs, invest the difference, and stop letting anyone make you feel like you're losing simply because you haven't signed a 30-year debt commitment. You're not throwing money away when you rent. You might just be the smartest person at that dinner table. If this changed how you think about the rent versus buy debate, drop a comment below and tell me where you landed. I read every single one. And if you know someone who's been guilt-tripped into buying before they were ready, share this with them. It might save them from a very expensive mistake. See you in the next one.